Hello and welcome, everyone. Excited to have you here. I'm excited to have everyone on today's exclusive Insights call with Dr. Sam Chandan. Today, you'll get some exclusive insights on the trends shaping rent affordability and demand in 2026, tenants' financial reality and the forces behind that so that you can price with confidence and plan with any purpose. And most importantly, the knowledge to ensure that you're always strategizing ahead of the market and not reacting to it. So we are in for a treat today. We're getting direct access to one of the most trusted voices in housing economics to answer your questions and make sure you're ready for 2026. Sam is a nationally recognized housing economist and real estate expert, the director of NYU's Stern Center for Real Estate and Finance, PhD and founding director of the C.H. Chen Institute for Global Real Estate, and the founder and chairman of Chandan Economics. And most recently, congratulations, Sam, appointed a senior at the West Point Military Academy. So, Sam, thank you for being here. We're really excited to have you here.
Thank you so much. I'm delighted to be here. Happy New Year, everyone. Obviously, a good juncture in the calendar to talk about an economic and housing market outlook as we get back to work and think about our plans for 2026. I have a lot of
Absolutely.
slides here. I think we're not going to get through all of them, Ryan. But
Yes.
what I will promise is that we'll make them available for distribution for anyone who'd like to take a look after the fact. But it's fairly information rich. So again, welcome everyone. It's great to see you here. If you have follow-ups, if you want to connect with me, please, do join me on LinkedIn. And I'll make sure to reply in kind. But as Ryan mentioned, my primary hats are to serve as the head of the global real estate program at Stern, the Chen Institute, and also to serve as chairman of Chandan Economics. The Chandan Economics has been partnered with RentRedi for many years, and I've certainly just been incredibly impressed with the work that Ryan and the team have done, in building an incredibly important suite of services for participants in the market and the data that's produced, off of which we're able to glean some real insights into how markets are performing. So I'm going to talk a little bit about the economy today. I'm going to talk a little bit about housing markets, and then Ryan's going to field some questions, so we have a chance to jump in together. So don't hesitate as you begin thinking about things that you'd like to ask. With regard to the macro economy, this slide is really a bottom line up front because I know I'm not going to get through all of my material. Where do we see ourselves along five of some of the most important dimensions for how the economy is performing? The first of these is overall growth, and as I'll show you on a slide in a couple of minutes, I think what we see in the data is that the growth trajectory of the United States economy is fairly robust. That's not to say that there aren't some very significant downside risks. But if you look at sort of where economists expected that we'd be a year ago, the disruptions related to changes in trade policy, some of the changes related to how it is that we fund some of our government programs, the potential for significant job cuts in Washington that may have spillover effects into other geographies or other occupations, irrespective of how any one of us might feel about those different things. We obviously have different opinions on exactly how it is that we might go about negotiating fair trade relationships for the United States with our counterparts in other parts of the world. But I think the nature of the disruptions that were being introduced, those little shocks every day of that lack of let's say stability, for better or worse, and a heightened sense of policy uncertainty, were really causing some concern amongst economists that we could see a significant slowdown in the growth trajectory of the U.S. economy. There are also certainly some concerns around how consumers were holding up. We're starting to see that the job market had been slowing. That's not something that we would attribute to either the previous or current administration. The job market has been slowing for some time, but the combination of job growth slowing down and these other factors in the environment, I think really had raised some concerns about how what the growth outlook might look like. Add to that one other feature, and I'll show you a chart on this a little bit. There's been a lot of excitement over the last couple of years amongst equity investors, just in terms of how stock markets are performing. For those of us that have a 401k or a discretionary investment account, we've had a pretty good couple of years, and that certainly has lifted spending and investment. The other piece of it is that when we look at the GDP accounting of the United States, so these are the numbers that really tell us what's driving growth in the economy. Some of it is going to be exports, some of it, or the balance of our exports and imports, some of it is going to be consumer spending, which is always the biggest piece of it. But one of the things over the last couple of years has actually shown up as a more important contributor than it has been in the past to growth. It's actually been investment that's been made by what we refer to as hyperscalers and others in the infrastructure that supports AI in the United States. That could be a data center, that could be power generation, it could be transmission lines, it could be chip factories. There's a lot of different things that go into making AI happen. And when we look at the most recent data, there's actually quite a bit of investment into this AI infrastructure, enough that it really shows up as part of the drivers of GDP growth. Because we haven't seen yet commensurate improvements in productivity, right? So we've got all these amazing new tools, but it's not the case yet that economy-wide we see ourselves becoming radically more efficient. And part of that is how we're using AI. There's a lot of really good business use cases that are emerging, but there's also a huge part of demand for AI resources that are about the stuff that you see on TikTok. And that, quite frankly, is not enhancing our productivity. If anything, is probably taking a little bit away. So we haven't seen those big gains yet. And I think what a lot of folks have been concerned about is, okay, how sustainable are these big investments that we're making in AI infrastructure when the productivity gains aren't there? All of that said, so far, as we head into 2026, certainly, looking in the rearview mirror at how we've done in 2025, the economy certainly performed better than most economists would have anticipated. And by some measures, it's actually performed more than just okay. That's not to say that we don't need to be cautious. We don't need to continue to pay attention to some of the things that might disrupt economic growth. There's, again, when we say disruptions or talk about stuff in the policy environment, let's just say there's a lot of unknowns, out there, and that can make it difficult for people to plan. So that's something that we want to keep an eye on. But overall, right now, in our baseline, imagine that we're modeling 500 different scenarios or 5,000 different scenarios for how the economy might perform. In that middle scenario, the baseline that sort of sits in the middle of all of these different forecasts, the growth outlook still looks pretty good. Part of that is that inflation is moderated in the United States. We're in a much more comfortable place than we've been over the last couple of years. We're not quite where we want to be. That target inflation number, for many reasons, and depending on which inflation measure you use, professional economists and policy economists use one measure of inflation. The general public and sort of all the nightly evening news will use a different measure of inflation, but we're still talking about roughly 2% as sort of our sort of comfort zone. We're not quite there yet. We're a little bit higher. We want to watch things like and consider what's going on in the geopolitical environment. Want to keep an eye on, okay, how does this impact the price of oil, our shipping lines, or being disrupted in a way that may impact food costs. But right now, and in spite of the tariffs, the inflation numbers look pretty tame as compared to where we were, let's say 2.5 years ago, and that's giving the Federal Reserve a little bit more room to begin reducing rates, and they've already started that cycle. They obviously cut them again in December. Those lower rates are helping to is helping consumers that may want to borrow to buy a washing machine or a dishwasher. They're also helping businesses to roll over maturing debt or to make investments in new factories. There's a lot of ways in which those lower interest rates benefit us, apart from the lift that we'll always get in the stock market, right? When bond yields fall, we're going to see some rebalancing where people pull a little bit of money out of bonds, put into stocks. That's going to give the stocks a bit of a lift. But overall, the inflation numbers, again, we're in a pretty good place as compared to where we've been. We're not quite to where we want to be. But the balance for the Federal Reserve, everyone has an opinion on whether they're doing a good job or a bad job. At the end of the day, they've got two key things that they're thinking about: price stability, right? So, is inflation too hot? Running too high or too low. So they want price stability, but they also want to make sure that Americans are employed. When they talk about full employment in the United States, they're not talking about literally everyone being employed. They're about what's the level of employment in the United States that is consistent with price stability. So what's the level of employment? What's the level of unemployment that is consistent with inflation running around 2%. It's an easy way to think about it. And what we see in the United States today is that while inflation is coming down, they're also concerned because you can see this employment number on the chart is a little bit weaker than growth and inflation. Employment is weakening, and it's weakening in a way that's pretty observable. And that's not a new phenomenon of the last 6 to 9 to 12 months. I don't want to blame it on anyone in particular. It's been slowing down for a while now. So what we see in those numbers is that, given the dual mandate of the Fed, they're having to think about, okay, inflation is coming under control. And I'm cautious. I don't want to start cutting rates, rapidly and then see sort of inflation, pick up again. But I've got a little bit of flexibility here because it's 2.7%, not 8.7%. Got a little bit of flexibility as inflation comes down. I really need to start paying some attention to what's going on in the labor market. And those employment numbers are slowing down in a way that hasn't really driven the unemployment rate up to worrisome levels yet. But directionally, we don't want to ignore what's going on in the labor market. And so there's a strong case, I think, for them to be lowering rates. But we're getting different messages from folks in the Fed, and I think they're being cautious, but we're getting different messages from folks that are in different types of leadership roles at the Fed in terms of what they anticipate for the path of interest rate cuts over the next year. Keep in mind that all refers to the Fed funds target rate. So this is the very, very short end of the yield curve. It doesn't impact lockstep, the 5-year, the 7-year, the 10-year rate. It's certainly not directly impacting, the 30-year mortgage rate in the United States either, which is going to be an important number, obviously, for all of us. So employment, again, slowing down, got to pay attention to it. It's a risk for 2026. The major area of weakness in the economy, because it is impacting people, people's ability to plan at a business level. Sometimes it's impacting their ability to make investments. We had a big signal yesterday from Washington about investment in single-family homes for rent. Most of my last 24 hours has been talking to folks about that. But when there's that sense of uncertainty around, okay, well, what might come next? Whether it's for some of us, it'll be things that we like, some people things that we don't like, but there is the sense of uncertainty around the degree of policy stability, how rapidly things are changing and evolving. That is a drag because it does impact companies' ability to invest when they do face that uncertainty. So that's a big source of that's a big cautionary note for us when we think about how businesses will drive investment in 2026 and how businesses will drive growth in 2026. That is different from how we may feel as individuals. Certainly, there are some folks who are unhappy with how the country's the direction that we're taking over the last year, and that may impact decisions they make about where to travel, where to go on holiday, whether to buy a dishwasher. We're not seeing too much of the discretionary consumer spending impact. We're seeing a lot of impact on sentiment. A lot of unhappy people, a lot of happy people, but it's not actually showing up as a big shift in consumers' discretionary spending patterns for those consumers that are well positioned in terms of their incomes, wealth levels. It's a bit of a different story for folks that are lagging behind in terms of, their ability to engage in the labor market, get that job, get a wage increase for those folks, it's a little bit tougher. That's why consumer health, you can see here, it's kind of middle of the road right now. When we look at the consumer sentiment data, it's troubling. And again, we want to keep an eye on that because historically, very weak consumer, sentiment, it would spell trouble for the economy. What's been a little bit unique right now is that although consumer sentiment is weak, consumers are still engaging, and they are still spending in a way that's sort of a little inconsistent, actually, with the consumer health data. It's a big picture look at sort of what we see, happening with the economy. A couple of data points to back it up. And again, there's all of these slides were updated as of last night's market close. So what you can see here is that, I'm not kidding when I say, the economy has been performing reasonably well. Don't worry too much about that first quarter negative number you see over here. It wasn't sort of that the core of the economy was slowing down. It's that in anticipation of tariffs, a lot of companies just accelerated their imports. So you might have read a story about like Apple. This is maybe urban legend, but Apple loading up planes with iPhones to get them into the United States before tariffs came into effect. That driving import numbers up a lot. And so the net balance of imports and exports actually, that shows up in our GDP accounting as a drag. So this big surge in imports actually turning growth negative, but it wasn't the underlying economy that had actually, contracted. And so you can see we've got these stronger numbers in the subsequent quarters. I don't think we're going to hold up at these numbers, but they're certainly better than what economists had expected. The other real positive indicator for us, because remember, no one statistic or indicator is ever going to tell us the whole picture for what's going on in the economy. Each of these is just a glimpse or, one perspective or one angle on what's going on. Industrial production is another really good indicator for us. And what it shows us is that, as compared to long-term averages, industrial production, how much stuff for companies producing, we're actually in a pretty good place right now. We're not far from, sort of the healthiest levels that we might expect or be able to see in the United States. We've also seen some improvement in economic policy uncertainty. That number is down. It's still highly elevated, right? The only times we've seen it higher than it is today, are during March of 2020 when we all got sent home and locked ourselves in our apartments and were worried about COVID infections. Again, with the benefit of hindsight, some of the decisions we made during that time were smart. Some may have been silly. However you want to think about it, there was a lot of nervousness in the world at that point. And then, in early 2026, when we were like, okay, well, what's going on with all these tariffs and changes in policy positions? Because it was pretty abrupt by any measure. So, it's come down a lot, but it's still higher than anything we can be comfortable with. So, what do you want to keep an eye on this year? It's the potential for these exogenous shocks. And by that I mean things that could come out of left field. A changed relationship with Venezuela, that may have unanticipated consequences for the availability of oil or for shipping lanes that could spiral into a larger regional conflict. Those are the kinds of things that I think we've really got to keep our eyes out for, that could impact the economy in 2026. The other thing that you see is that one of our traditional measures of whether or not we're headed into recession, is the spread between short-term and long-term interest rates. And what this chart is showing us is that if you look at 2023 and 2024, the numbers were, there were big, sort of, red flags waving in every direction by the textbook. What the numbers were telling us in 23 and 24 is that we're on the cusp of recession. This indicator has proved to be pretty reliable historically. This time it was not. And you can see that, the numbers are improving now. And we're in a more normal place now in terms of what essentially this is telling us what the market thinks, about the probability of recession. The market's telling us that, we're in a much more comfortable place now than we were about a year and a half ago or 2 years ago. That's good. Long term and medium term. So, this is something that's good material for us in the 5 to 10 year outlook, is that we've still got a basic problem in the U.S. economy, which is that, our indebtedness is unsustainable. You can see from this chart here, our federal debt as a percentage of GDP is at about 120%. Um, the last time it was anywhere near this high was in the final days of World War II. The difference was that in World War II, we had a finite period where we were spending a lot of money to fight a global war and then to support reconstruction of the global economy. Today, while we do have wars, the real driver here is systematic imbalances and structural issues with debt. So while none of us like the idea, I think we all hate the idea of making changes that are going to hurt people in terms of Medicare, Medicaid, Social Security. The bottom line right now is that there are no good answers for how it is that we correct the structural problems with our debt and our deficits in the United States. We're all going to have to absorb a little bit of pain if we're to right size federal spending. And we're going to disagree about where those cuts should be made and how much might come from how much of this we might solve from GDP growth. At the end of the day, we've got some really serious structural problems in the United States. Long term, if we don't address those, it's going to make debt more expensive and it's going to crowd out private investment as a result. So we want to keep an eye on that because it's very, very real. You can see again that inflation has come down. We're running at about 2.7% right now. Our average is about 2.6 in terms of what the market expects. The 10-year break-even inflation rate, which tells us a little bit about sort of what market's expectations are, is down to about 2.24 right now. So the market really does expect that inflation is going to come under control. I'm not quite as optimistic as the market, in part because we've got a structural issue with the labor market in the United States. We've got a lot of younger people, we've got a lot of older folks. We don't have enough in the middle that are working to support the larger population. So that constraint on the labor market is going to exert some upward pressure on wages. Those and your higher wage, basically, if the labor market's tight long term, maybe not tomorrow, but if it's tight long term, then employees are going to be in a better position to negotiate wage increases, and that's going to tend to push inflation a little bit higher than the numbers that you see over here. We have seen mortgage rates come down a little bit, but they're still nowhere. That's the blue line. They're still nowhere near sort of where we were, for really, most of the last, 15, 20 years. They're still high, and house prices are still at, historically high levels. What that means for us in terms of the housing market side is that in spite of house price growth moderating, we're really not, and I'm going to jump over these labor market slides real quick. You can see sort of a bit of an uptick in, the unemployment rate to 4.6%, but claims not going up. So, while the unemployment rate is going up because more people are looking for work, it's not the case that, a lot of people are, it's not the case that a lot of people are losing their jobs involuntarily, right? People are staying put, but new entrants to the workforce, it's tough. And as an academic, I can attest to that, whether, it's my own institution or others, talking to colleagues at different universities and really good ones, around the country. It's not an easy year, for a young person to be in the job market. I think it's part of what this data reflects. There are just fewer, as this chart shows, there are just fewer jobs open and available, for every American or every person looking for work. You can see the red line coming down. The bars show job creation. This is where I said job growth has been slowing down for years. It's not attributable to any specific administration. Job growth peaked after the pandemic, but it's been slowing pretty consistently since then. And part of that just reflects that there are fewer jobs being made available. In the days after the pandemic, there were 2 jobs out there, for every American who was looking for work. We're at less than half that now. We're at 0.91. For balance, we kind of want it to be at around 1. We're a little above 1. Market's a little, sort of a little weak right now. Can't really support those kinds of outcomes. And so disposable income, with a weaker job market is growing a little bit more slowly. Those personal savings rates have not skyrocketed in a way that people suggest that people are getting really nervous. People are still out there spending. They're still going to restaurants. They're still doing other things, but they are really nervous. And you can see, from this consumer sentiment number, consumers are not in a happy place, even though they are, out there, spending. Where that becomes important for us is thinking about, okay, what does it mean for how people think about buying houses, how they think about renting? the pace overall, housing has never been more unaffordable for at least the period during which we have really reliable, strong data. Home ownership is unaffordable. Home ownership for first-time home buyers is unaffordable. We have more houses coming online. We have a slowdown in the pace of house price appreciation, but the medium to long-term outlook on, because of structural factors in the United States is really one that supports renting. That doesn't mean that people are abandoning their homes. Doesn't mean that people aren't going to buy homes when they're able to or when they're ready. But on balance, for a young couple in their 30s, or a young individual in his or her 20s, maybe just graduate from college or an MBA program, home ownership is going to happen a lot later than it has in the past, and that supports rental demand. That again reflects a couple of different things. For some folks, it's preferences. It's no secret. I think we all understand that there are changing demographics in the United States. We have children substantially later than we have historically, and that pushes out the time horizon for home buying and moving to more suburban or transit-oriented locations. But also there's a preference issue, but also there's just a basic affordability issue. And affordability, but availability as well. There are very few, first-time homebuyer type homes out there, and they're not affordable by any historic measure. So this doesn't mean to say that there aren't pockets of weakness in the rental market. There certainly are. But what it does mean is that in most markets around the country, the medium to long-term outlook for rental demand looks good. Where we do run into trouble sometimes is on the supply side, because we've had over the last few years, we've had a surge in multifamily supply broadly. I'm not too worried about that because we see that inventory being absorbed at a fairly healthy pace last year and over the next couple of years as well. You can see reiterated here in the housing affordability trends. It's never been it's never been less affordable to buy a home. The income gap is large, and the payment share, the percentage of income that would have to go to housing payments, is also unsustainably high relative to whether it's any objective measure or whether it's simply sort of what Fannie and Freddie would require for a first-time home buyer. So a lot of renters stay put. And for a lot of people, the key then is to say, okay, well, how do I, as a small landlord, think about maximizing tenant retention? I know that these folks are in the rental pool for a while. What kinds of things can I do to make sure that they remain a renter, not just a renter, but more importantly, that as long as they are a renter, how long will they be a renter with me? And what kinds of amenities, what kinds of services, what kind of programs can I put into place at a small scale as an independent landlord that will enhance retention for me? So, because I don't want to lose the money or that's associated with tenant turnover. I also realize I'm not going to be able to do the same kinds of things with amenitization that a large landlord would do if they have 1,000 units in their building, right? It's just a different sort of a game that I'm playing. We also know that the supply side is becoming what's coming online is a little bit more limited. Single family and multifamily housing construction have come far off their peaks. The numbers are still much higher than where we were, for most of the period following, the housing boom of the 2004 era. But it's come, we're down, almost 50%, at this point. So some of those supply issues, are real, and there's a variety of drivers here. It's, the availability of land, how that land is zoned, the cost of construction materials, importantly, the availability and cost of skilled construction labor. Is also another really, really big factor here that's limiting construction. I think the biggest one for me, though, is sort of how land is zoned, whether it be in transit-oriented communities, suburban communities, or urban areas, and the resistance in a lot of local communities to upzoning. With regard to the announcement about then, limited supply, not a lot of homes available for sale, institutional investors being limited in their ability to buy single-family homes. We'll see how that translates into actual policy. But I think what I'd offer is, and Jonathan, perhaps, or Ryan, if you could share a piece I did with the Commercial Observer yesterday on this. I think it went to print yesterday evening on this issue. There's at the national level, there's not a lot of evidence that institutional investment into the single family home space and buying of existing homes is the major driver of house price appreciation and deteriorating affordability. Nor is it the case that individual your small independent home buyers that are positioning them for rent are really driving this trend. There's a lot of other stuff going on in the market, and it's principally about our ability to bring new supply online. The other thing that we've seen is that as house prices have skyrocketed, a lot of these folks that were in the SFR business, the single family home for rent business, they've really shifted their business model to BTR, build to rent. And so folks that are in the BTR space, they're bringing net new homes into the market. They're actually increasing the available supply. They're not taking away from the inventory. So these are all real issues for us, and they show up in the numbers. We've got more rental households than really we've ever had but before, and by a substantial margin. The other thing is, for folks who are thinking, I know that many of you are independent investors in this space, but for those of you who may be thinking about, small scale development, I think what we see, I might have some commentary out there from the last couple of weeks or months, not really expecting significant changes in the government's relationship to the government-sponsored enterprises over the next couple of years. It's a fairly complex thing to end conservatorship, and which is part of why 17 years on, it hasn't happened, or 18 years on now, we haven't ended conservatorship. But for those of you who may be thinking about development investment in a small scale, what we do see is real improvements over the last couple of years in the availability of financing to make small and large scale multifamily investments. You can see it in balances outstanding improving last year, but also our measure of multifamily mortgage lending standards. They're not expecting huge, negative disruptions in the availability of capital. For those of you who may be thinking about acquisitions, small scale development, multifamily mortgage underwriting standards have really, normalized. Part of that is just competitive pressures in the market. But I think for a lot of folks, that's good news from my perspective. Think about risk a lot. I'm always thinking about where are the pockets of the market where we haven't just normalized lending standards, but maybe where lenders are taking a little bit too much risk in lending. That's always sort of a source of concern. And certainly there's some risky multifamily mortgages out there. There's no doubt about that. They're generally not on the balance sheets of Fannie Mae and Freddie Mac. They're more likely to show up elsewhere. But in terms of sort of then what this means on balance for the outlook over the next year, about sort of a lot of sources of uncertainty, but and we've got to be very mindful of those. But in the baseline, the real overarching trends for us are with the slowdown in supply in multifamily, and still healthy demand, consumers being in a tough place with regard to home buying. I know the National Association of Realtors has I don't want to misquote them, but I think they anticipate that single family home sales will tick up by about 20-25% this year. On balance, still a very healthy demand outlook for apartments, less new supply coming online. That supports sort of good occupancy rates. You'll manage your tenancy well so that you're maximizing on-time payment rates as well, because there's some variation there. But the broader economy support for all of this, the economic outlook looks good. We do need to pay very, very close attention to what happens in the labor market, because that slowdown in job growth. I personally, if you had asked me a couple of months ago, I would have anticipated that it would have turned negative by now. I'm happy to be wrong about that, but we do need to keep a close eye on it, because the folks that are having the most difficulty finding jobs now are the natural pool of new renters. And so that is just a source of risk that we want to be really proactive about in managing our individual portfolios. Ryan, I've exhausted my time. I'm going to turn off my screen share here and give it back to you.
I love it. I appreciate the whole presentation, Sam. It was great to see
Sure.
it.
Yeah.
I know we have a handful of questions from people in the chat, and even some that people had sent in ahead of time that I'd love to throw your way and get your take on any piece of this for everyone listening.
Sure.
So the first that I have here, I've got one from Chris who's live with us here that asked, do you see the mortgage lock that's in effect easing in 2026 with 50% of mortgages under 40% and 70% under 5%? It seems that this is the pressing issue with sales volume and affordability.
Yeah, we've all got the golden handcuffs on. I refinanced into a 15-year at 1.95% during the pandemic. I felt like the luckiest guy in the world. My place isn't exactly, what I want right now, but there's not a chance that I am moving into something slightly larger if it means going from 1.95 to 5.95. That's just not going to happen. The So I'm stuck. I'm stuck. But like Chris, you're describing, it's exactly the scenario in which a lot of people find themselves. What that does mean for us is that to really unlock that piece of the market, we need more folks to be we need more, first-time homes, new single-family home sales, and there'll be a bit of that because of construction, so that'll help to move things along. We need more people to be at a transition point in their lives, either becoming empty nesters, moving into independent or assisted living, buying an existing home, but for them for the first time. Um, and we need mortgage rates to come down to narrow, that gap between what people have in place and what's becoming and what they can get. I don't anticipate that this market is going to unlock entirely in 2026. I think that'll be really really tough. Just the policy supports that we need to artificially suppress mortgage rates down to levels that we had prior to the pandemic just aren't there. So we'll get a little bit of help, but I think the NAR's estimate, barring some quirkiness with the economy, assuming the economy does continue to chug along, I do expect that an increase in single family home sales on the order of about 20% is probably what we're looking for.
That's great. That's great. I've got another one here from William. So he had asked, uh, with interest rate expected to stabilize or decline, do you foresee any increased institutional competition for small multifamily properties in 2026? And what are the strategies that independent landlords can use to remain competitive or exit favorably if necessary?
Yeah, so I mean, I don't see institutional buyers, moving into the market for small, independently operated multifamily. I think there was some obviously. I mean, if Blackstone at one point yesterday was down about 10%, on the news of the SFR business coming under scrutiny. The and Ryan, maybe this has been an ongoing topic for me. If you want, maybe share
Yeah.
my congressional testimony from 2022. At that point, Maxine Waters was the chairman of the House Financial Services Committee. But I
Mhm.
think my message to all members of the committee at that time was that the data isn't really there to support this kind of intervention, but there are a lot of other things going on. There's other considerations.
Right.
The the So in terms of competition for these assets, I anticipate it'll increase marginally because you got a lot of folks
Mhm.
that I think are going to be entering the independent space. But I expect that most of the competition you'll see will be from other folks who look similar in terms of the
Mhm.
kind of equity, the resources they have, in terms of the ways in which they're accessing debt, in terms of their capital stack. It's not like you're less likely to see a large private equity firm with hundreds of billions of dollars of assets under management suddenly decide that it wants to make a claim on a space that has traditionally been dominated by small independent landlords.
Mhm. That's great. That's great. This next one comes from Lily and a handful of others that have asked somewhat similar questions as well. But the question from Lily was, what's the impact of the new president's ban on corporations owning rental homes?
Yeah, so I mean, this is the big one over the last 24 hours. I
Hmm.
think that the signal from the administration about its intention, is new. The administration is not new at this point. The But I think we have to wait and see sort of what they actually do.
Hmm.
the the it's bad for a couple of specific companies that have done quite well in this space, but I'm not too worried for a couple of reasons. You know, if I'm going to argue in front of Congress that institutional buying of single-family homes is in most markets and nationally is a small enough percentage that you can't blame that for house price increases. Then unless there's some weird asymmetry in the market, pulling those investors out, it doesn't mean that the prices are suddenly going to collapse. They're not the ones who push them up. So pulling them out of those markets is not going to see them reverse. That being said, there are certainly a handful of markets, and perhaps even more than a handful of markets around the country. There's I think in the 20 markets where institutional investors are the most active, they may own something on the order of about 10 to 12% of, they may account for 10 to 12% of single family home sales. So there are certainly markets where they are, really meaningful players. Overall, if you're one of the big institutions, if you're one of the big private equity firms that's in this space, you don't like this at all. But what does it mean for market dynamics? In a handful of markets, a big source of demand goes away, and then single family home prices fall. But there again, it's going to depend. Are they required to exit their legacy portfolios and what they hold on their balance sheet? Or will a forthcoming rule be interpreted, or executive order be interpreted to mean that you simply cannot acquire new single family home rentals? That's going to make a big difference, right? Because if they're suddenly told you have to sell everything that you hold, then in some markets there's going to be a flood of homes available for sale. More likely, they're not going to be able to acquire new units. The other possibility is that it takes the form of, and I'm speculating here, it takes the form of you can't get GSE financing for these kinds of acquisitions. And if that's the if that's the way it expresses itself, then it's not going to make much of a difference at all. So I think we've got to see a little bit of what's in the details. But nationally, I'm not overly concerned for how it affects housing market dynamics. Am I concerned about my personal investment, in a couple of private equity firms? Yeah, I mean, I didn't have a great day yesterday.
Yeah, that makes a lot of sense.
Yeah.
So we have one comment here that I'm hoping you can expand on as well. We have a comment from Matt Mason from
Yeah.
Arbor that
Yeah.
commented that consumer spending seems to be being carried by high-end earners in the so-called K-shaped economy. Are
Yeah.
you able to expand on that and what it could mean for economic growth in 2026, especially for the stock market?
Yeah, I think as usual, Matt's right. And we do have the K-shaped recovery is probably not as extreme as we see it sometimes described, but it is real, right? We know that folks in higher income and wealth brackets are doing a lot better than folks at lower income wealth brackets. The wealth effect is easy to observe, right? Because for folks who do have a substantial 401k or who have an investment account, the last 3 years have been pretty good. The For folks that don't have those things, they've completely missed out on the run that we've had in the stock market. That's not There's no reason to expect that we're going to see double digit gains year over year on a sustained basis. Corporate profits don't grow fast enough to actually make that a reality. Where my expectations for 2026 are more modest. But even on an income basis, I think what we see is that folks that are on lower income brackets that are more income constrained, the last few years have been really tough, and more than the last few years. The one of the risks for folks in the multifamily space is that a big source of the a big source of the strain has been increases in rents. And so less likely at the federal level, but certainly at the local level, we are seeing over the last 12 months, a larger number of initiatives at the local level to constrain rent growth. Right? In New York, it's very clear. In Boston, clear attempts as well. I think in most cases, these are well intentioned, right? We want to help to preserve affordability. But what I'd also say is that in most of these markets, the way in which local elected officials are going about limiting rent growth, through rent controls, rent stabilization measures is entirely counterproductive. It's going to limit new supply coming into the market, and long term, that is going to undermine affordability, not enhance it. I do want to come back to one other thing. On this question of housing market dynamics, one of the key points that I made for Congress and in yesterday's Observer article is that I firmly believe that single family homes available for rent, whether they are existing homes that were acquired or whether they are homes that are built through the BTR pipeline, are essential to how we think about housing in the United States. Not everyone who wants access to all of the benefits that come with being in a single family home, whether it be the yard, whether it be the space, whether it be the access to a good quality public school or a grocery store, a public park, not everyone who wants access to those things can afford to own the home or can afford or necessarily wants to own the home, depending on where they are in life. Ensuring that people have the opportunity to rent a home is an absolutely essential part of how we diversify the set of housing opportunity for American families. Steps that we might take that would limit access to single family homes for rent or that would constrain the lenders that make financing available, for BTR, I think, are not things that, are really going to be to the benefit of American families.
Mm-hmm. It makes a lot of sense. I know you mentioned a little bit of rent stabilization in there. We had a question from one person, Joseph, here that had asked what your thoughts were on the housing market outlook for various government programs like Section 8, given the announcements at the federal, state, and local levels. Do you have any thoughts you can share on those?
Yeah, how about this? I promise that if that we'll know more about this in a couple of months, and if your audience is interested, I'd be delighted to come back and talk a little bit more about that in probably the March-April timeframe.
Love it.
The Unfortunately, I've got to hop on a plane soon, so I have to exit
No
in a
worries.
couple of minutes. But listen, Ryan, and to everyone
Yes.
at Rent Ready, all the folks who've dialed in with the questions. I apologize if I didn't get to nearly as many of them as I see popping up in this list. I just really appreciate your spending part of your day with me. Please do connect on LinkedIn. I'd love to hear from you there. It's also where a lot of my own research and work in the policy environment gets posted. So take a
Perfect.
look for me there. I'm really easy to find. It's just Sam Chandan.
Well,
Thanks so
thank you
much,
so
Ryan.
much again, Sam. I really appreciate
Yeah,
having you here and all the questions you've answered. For everybody
Yeah.
else, if you enjoyed today, we have a upcoming webinar with some amazing guests on the 22nd at 3 p.m. We can drop the link for that in the chat for you. So if you'd like to sign up for that one. Also, like Sam mentioned, if there were any topics he mentioned today that you want to hear more about, throw that in the chat. We definitely take that feedback seriously, and hopefully we'll be seeing Sam back on here soon to answer more of your questions. But thank you again, everybody. And Sam, thank you again for all the time. I really appreciate it.
thanks. See you soon, Ryan.
See you soon.